Welcome, everyone, to our first afternoon session. I hope everyone had a good lunch. Great conversation with the Bahraini ambassador. This session is entitled Financing the Energy Transition. We got into some of these finance issues this morning, but we're going to dig in a little deeper. Robert Mogielnicki is going to lead that conversation in just a second. This is going to be our Show Me the Money segment to wake everyone up after the lunch, so I hope you enjoy it. Let me introduce the panel. First, we have Torsten Ehlers. He's a senior finance sector expert at the IMF's Monetary and Capital Markets Department. Jamil Wyne is the co-founder of Riffle Ventures, and he's a specialist in climate technology and investment in emerging markets, focusing on venture capital and entrepreneurship ecosystems. Rachel Ziemba. Rachel is the founder of Ziemba Insights. She's also an adjunct fellow at the Center for New American Security. Thank you, Rachel. And then we have Robert Mogielnicki. Robert is a senior resident scholar at AGSIW, and he's a specialist in political economy of the Middle East and North Africa. Rob, I'll turn it over to you. Thank you.
All right, great. Thank you very much. I hope everyone's satiated and ready for the next round of conversations. I thought I would kick things off with a saying my dad used to tell me when I was younger. He would say, money isn't everything, but it sure makes things easier. I think it's appropriate for today's conversation because we know, when it comes to climate finance and financing the energy transition, that it's not just about money. It's about increasing awareness, it's about political will, and just from an anecdotal note, at my time here at AGSIW over the past several years, looking at the Gulf states and the political economy of the region, we've started to see a greater awareness of climate-related considerations, targets that need to be met, and also political will, not just in the Gulf, but in other parts of the world that speakers, Roger and others mentioned, the U.S., Europe, China as well, just to some degree, some of these important hubs. And this has also been echoed by statements of officials from the region. Kate, in her scene setter, mentioned, and I think also repeated today, that Sultan al-Jaber had talked about what would actually be needed on the financing side to meet some of the goals related to renewable energy capacity and the targets associated with them, requiring at least $6 trillion. And so, if you take all of these things together, it's quite clear that governments around the world are thinking about how to best position themselves amid the global energy transition. This is especially the case for the oil and gas producing countries in the Gulf that we look at very closely here at the Institute. But it's also the case for the U.S. government. And as Rachel will talk about in just a few moments, in more detail, when we think about the IRA and some of the regulations around that initiative, but also other industrial policies that we're seeing coming out across the globe and in developed economies. Now, the private sector has a big role to play here, but accessing affordable finance for these projects, it's going to be a challenge. I don't think we can take it as a given. And along the way, we're going to see plenty of winners and losers, to use a typical framework for thinking about political economy. But maybe I'll bring things back to that one statement we've heard a number of times today, with the key challenge being turning billions of dollars into trillions of dollars. And how do we do that? Not in the space of decades, but in the space of a few short years. So I'll turn the trillion-dollar question over to Torsten to first get us thinking on a very broad macro view about how we can, and if we can, move from billions to trillions of dollars in climate finance. And also, where is this money going to come from your point of view?
Thank you so much. Thank you, Robert, for having me. So no pressure. It's an easy question to start with. Since actually the problem has become even bigger since the major MDBs together with the IMF published the eponymous report called From Billions to Trillions, the role of development finance. Because we're now talking about multiple trillions, right? As you rightly pointed out, Robert. So it's probably more somewhere between $5 and $7 trillion a year by 2030, and that's a lot of money. So as you can imagine, with those kind of magnitudes, a lot of things will have to come together. That's at least the view of the IMF. But let me perhaps start with saying that, apart from the magnitude, there are two other very important aspects that come into play. One is the quality of financing. By that we mean the matching between investment and financing. So the question of where the money is going to come from, but then also where are the right projects going to come from. So the two have to be matched, obviously. And then the other really, really important aspect which really changes how you think about policy recommendations is the issue of speed. Because if you had a lot more time, then all the policy recommendations would be quite different. Given the lack of time, there is certainly a role for more intrusive policies than usual. I think that's fair to say. So on the question of where the money is going to come from, so what we have done, for instance, in our last Global Financial Stability Report, in one of the chapters that I led, was to ask precisely this question. And, on a very simple question, the first issue you can look at is the money going to come from the public sector or the private sector, right? And so the IMF is in a very fortunate position that we do long-term projections on what the fiscal space is in every single of our member countries, 190 plus, for the next 15 years. And if you take this as a basis and then you make some pretty generous assumptions on how public investment is going to shift towards greener investment projects, even then you kind of come to the conclusion that most of the money will have to come from the private sector at the end of the day. So our estimate is around like 80% of all these investments will have to come from the private sector. Globally, for emerging markets is even more. So if you take emerging markets and developing economies, excluding China, because China is kind of a separate case, then the number goes up to 90%. And so if you buy into to me, it's a fact that most of the money will have to come from the private sector. But let's assume that this is the case. Then obviously, that leads immediately to the question, okay, how can you attract that level of private investment? So now, most of the money will be a reallocation of existing investment, but that's still challenging to do. There will be some additional investment, but, a relatively small part will be additional investments. Most of it will be reallocation of existing investment. And so, in order to raise investment for climate, you need a very good investment climate, right? I mean, the private sector has to be comfortable with investing, and not only that, it also needs the prospect of adequate returns on any investments that are going to be made. If that is not the case, right, it's going to be very hard to raise these kind of magnitudes of financing. So that leads, for us at least, that leads us to believe that there is still a lot of scope for kind of the bread and butter of the IMF. The usual policy advice that we give on macroeconomic resilience, development of capital markets, but also perhaps some newer financial sector policies that come in, development of green capital markets and all that. But then to generate adequate returns, the IMF is very vocal also about the role of fossil fuel subsidies. Okay, in particular, those on coal, I'll come back to that, but also in other aspects. So for us, of course, it's not only important from a climate aspect, but also from a fiscal stability aspect. Fossil fuel subsidies have increased massively. Mainly that's due to things that happened in Europe after the Ukraine invasion. But in general, they remain very high. So that's one thing we advise, because that will also, of course, lead to fiscal consolidation. But then, you know, the carbon pricing may also be an aspect, right? We have 46 national carbon pricing schemes globally right now, and we have a lot of data on how this is working. But this is, you know, this may not be good advice for all countries, in particular for developing economies. You know, it may not be the appropriate instrument. But the key at the end of the day is to create investment opportunities. And there, one of the key things that we have been observing is that if you look at the countries' NDCs, national determined contributions, around the Paris Agreement and what countries have committed to, oftentimes, in particular in low-income economies, but also middle-income economies, there is no clearly defined plan as to how to achieve these goals. In particular, you know, in terms of investment projects, what needs to happen in the energy sector. If you're really serious about achieving these goals, we believe that there should be more planning and a more concerted effort, in particular on the side of governments. Of course, there are many other issues around technology transfer. So if we think about carbon pricing, really how this works is that you always believe that, you know, by raising prices on something, right, there is a substitution effect. The problem is, however, that in many emerging economies, maybe there is no substitution because the alternative technology that you would hope these countries to invest in is simply not accessible. So there, I don't know if Jamil will talk about that, but that's also an interesting aspect. So access to technology here is going to be a very important topic for emerging markets. Now, for a lot of emerging markets, there will be help required, you know, outside help. So multilateral development banks have to do more. I think a lot of what was outlined in the report back in 2015, moving from billions to trillions, I think is still true. I think there are a lot of issues that still need to be tackled, long-standing issues. But then there has been a lot of movement, you know. So for the first time, MDBs collectively, the major MDBs have spent more than 100 billion a year on climate finance. And 60 billion of that has gone to middle and low-income economies. So there's also good news. And that's actually a doubling from the year before, so from 2021. So the momentum is there. And also what we believe is that the investor interest is there. And now we believe that there needs to be a lot of focus on supplying the right projects and also providing the right investment climate for all this to take off. So one issue that Robert also mentioned, and that is my last point, and where also I think outside help is needed, perhaps from MDBs, is the fact that a lot of in particular on the energy side, a lot of the investments that we are talking about are highly capital intensive, more capital intensive than, let's say, alternatives. And you know, with globally raising interest rates, it has become even more challenging, right? Because then the whole cost structure is changing. So capital-intensive projects become even less attractive than they used to be. So perhaps here there is also room for finding new financial structures, new types of financial instruments. In particular, you know, it is conceivable that MDBs could also engage in equity type of investments, which they are hardly doing so far. So if you look at climate finance, the 100 billion that I mentioned, only 4% of this came in the form of equity. And equity would, of course, be, you know, the type of instrument that could catalyze a lot of other types of investments, like private investments, you know, for instance. So there is also probably more to be done. And last but not least, there is also, I think the IMF is also, you know, working on that. We have created a new program which is called the Resilience and Sustainability Facility, but I can talk about that later. Thank you, Robert.
Thank you. We'll definitely give you the microphone back, but not before we hear from Rachel and Jamil. Rachel, can you bring us a little bit closer to home here and talk a bit about the impact and the trade-offs of the IRA, as well as some of the other industrial policies that are coming out of whether U.S. or other developed economies that you find relevant for this conversation, in particular about energy and the technology space?
Sure. Okay, good. We're back on. Thanks, Robert. Thanks to the Institute for this great conversation. So yeah, to that end, I mean, I think useful to kind of look at both the industrial policy space, but also especially something we've seen, I think, in the last few weeks of the way in which trade policy has been sort of brought to bear as one of the tools. When I speak with clients about things ranging from industrial policy to sanctions implementation and the like, I often, when I'm thinking about the Biden administration, I talk about them using all the tools, right? So a lot of the tools in the toolkit for things that are a priority. And we've definitely seen that across renewable energy. We've seen attempts, the limited kind of trade policy, trade agreements, sectoral agreements tend to have labor and environmental standards. There's been a push. I mean, I don't want to oversell any of that. We'll come back to that. There's been a push in the interaction with the IMF and the MDBs to, focus in on how to leverage finance for climate. But I do think the sort of biggest sort of game changer has been this willingness to use the U.S. balance sheet in creative ways to try to not only support clean energy supply chains, but also at the same time semiconductors and a whole variety of other sectors that in turn might increase demand for power. But let's leave chips aside, maybe. We can come back to it in the Q&A. So on the, and for me as someone who started my career doing a lot of work on how countries in the Gulf were creative about their balance sheets, mostly through sovereign funds, it's sort of interesting to see in a sense this whole spectrum of policies being used. Maybe we'll come back to that. But in the dynamics of the U.S. creating these, sort of these incentives to roll out more both renewable power, to try to build up new industries, battery manufacturing, electric vehicles, to do a lot of these things at once. Also then, there's an inflation and price pressure dynamic here, but it's also really aligned energy policy with broader economic security, economic sort of interest, jobs, job security questions, which I think then lead to a series of trade-offs that, of course, are political, but create questions that we have to face down the line. Now, one of the big drivers of the shift in recent years has also been this something that was exacerbated by the pandemic, but the security concerns about Chinese dominance of a range of different supply chains, but especially renewable energy supply chains. And so the fact that the U.S. and to some extent Europe has shifted from wanting, at least under this administration, to add as much renewable energy capacity and supply chains as possible, perhaps as cheaply as possible, to one where it's also about adding jobs and building that industry, I think creates a set of trade-offs and some opportunities, but for not only the U.S. and allies, but also other trading partners. So we end up with these multiple goals. And so and I think I was speaking to someone at the lunch break about, many European countries as well, parts of the government sort of maybe are still focused on the cost efficiency sort of rollout, and others really focused on building out this industrial capacity. So at the end of and so I think the recent measures that we've seen, for example, the tariffs on electric vehicles and on a variety of sectors that we saw rolled out in the United States a couple of weeks ago, are sort of part and parcel of this. These are all in sectors that the U.S. government has spent or plans to spend a lot of money at home. They're also sectors that China's been investing to build more capacity. But in general, they're not on U.S. shores yet. Some U.S. allies may sort of be having a lot of electric vehicles. And so it poses, not only is it connected and impinges on the other policy tools, but it also, sets a bit of a different path on the trade policy side at a time when I think a lot of people, myself included, have been quite critical of where the ambitions of U.S. trade policy. So it creates an interesting moment where not only the U.S. but also European allies are worried about what they see as Chinese overcapacity, especially on the auto sector front, but also on solar panels and on the like. but means that the tools the Europeans might use, even on the trade policy side, might be different. The Europeans have been very much on the record of saying, we don't want preemptive tariffs. We're willing to sort of impose tariffs for damages. So I think we're in an environment where there's been there's a recognition of the need to act on the energy transition. There's there's a willingness to spend additional funds, but when the rubber hits the road, I think it becomes more difficult. I want to just take a moment to talk a little bit about critical mineral supply chains, both because it's quite important and there's some interesting stories from some of the countries in the Gulf, how they're evolving, but also because I think it's emblematic of some of the broader questions that we're talking about here. And so part of the challenge here comes down to the fact that even though the raw materials in, let's just say, battery mineral supply chains, because we might have 50 plus different critical minerals and we need to subdivide them, this is not the time and place for that. But on the battery side, they're sourced in many different countries, but the bulk of them are processed in China. And this is a stated concern from U.S. and other countries, and really a desire to reduce, China's role to reduce those choke points, which has led to a lot of agreements between the U.S. and some of its friends, especially Australia, other developed mining producing countries. But it's also led to a lot of questions about if the push is about friendshoring and a recognition that, of course, these supply chains can't fully be created in the United States, does the U.S. have the right friends? I would say probably not in total, because I think there still hasn't been a dynamic of how to get countries that would like to have technology transfer and also financial resources from both the U.S. and China. Also, a question in some of these areas, the United States and allies aren't necessarily the ones that have the technology to transfer. So I think it also reflects issues around labor and environmental considerations and the like. We're at a point, an interesting inflection point, where many emerging economies that have these resources are looking to move up their own value chains, right? I mentioned technology transfer earlier. When we sit in Washington or New York, where I live, sometimes we're too quick to use the terms resource nationalism when countries want to move up the value chain. But I think very much sort of interesting question marks about where's the ideal location of these supply chains. And these are conversations. When I look at the amount of money that's being spent, say, in the battery and EV supply chain in countries like Canada, what you'll notice is the vast majority of the money that's been promised is at the sort of last mile project. So for the battery manufacturing next to the auto plant that, of course, creates jobs that they don't want moved to the United States or to China. Now, it's very difficult to build mines. It's even maybe more difficult to build processing facilities and build out that whole supply chain. But I mention this just in the context that these competing trade-offs and goals can make it more difficult, or definitely raise the cost, but also can make it more difficult to find the right partners through the chain. Now, they also create opportunities, right, especially for countries and for companies that are willing to go into jurisdictions in this way. And that maybe brings me to kind of concluding points on the Gulf and on this sort of critical mineral piece. There's a lot of talk in Washington about the role that Saudi Arabia in particular, but also the UAE is playing in its foreign mining interests. Probably not a lot of information known about it yet. U.S. officials have definitely gone out of their way to sort of highlight that there is partnership opportunities here. It will remain to be seen what the dynamics in Southern Africa and East Africa will materialize. But I do think in this environment where selling industrial policy initiatives tends to be pitched in with a frame of pressure on China and anti-China policies, I think that there are sort of difficulties balancing these, sort of these trade-offs. The other questions, I think, ahead, more generally, we spent some time this morning, highlighting how much national oil companies and others are really investing abroad. When we looked some years ago at the role of sovereign funds in investing in clean energy, we really found that most of them were still investing in developed economies because of rule of law issues, depth of capital markets, some of the things that Torsten alluded to. I think one of the interesting questions going forward is whether some of these de-risking strategies that are designed to build out these new supply chains, whether they can be created in a way to actually de-risk, or whether it just sort of adds costs and diversifies supply chains in that way. I haven't talked about the fact that if tariffs are going up on Chinese products in the U.S. and Europe, that maybe there'll be some displacement effects and maybe some costs might come down in other contexts. But I just think we're at an environment where some of these big economies are looking inward, and new rules are being established, new costs are materializing, and so I guess it makes me cautious about the ability and to work together to meet some of these goals, and that's clearly necessary to turbocharge that. I'm going to stop there. I'm sure that's well beyond my allotted time, and look forward to the comments.
Thank you, Rachel. Jamil, we've talked in these opening remarks about the trillions of dollars needed for climate finance and where that's going to come from. At least Torsten's very, I guess, you're very wise, or at least brave, to offer put some actual figures on this, with 80% coming from the private sector for developed economies, and even more, 90% for emerging markets. We've also heard about the trade and industrial policies coming out of the U.S., Europe, and this idea that Rachel is giving us, that big economies are looking inward in a very serious way. But if we take it to another level that I think you're very familiar with, I mean, what's the role of climate tech and investing in climate-focused entrepreneurs? And how central do you see this type of investment being to meeting the climate goals that we're talking about today? And also, if you could link your comments into the significance for emerging markets, because we've touched a little bit on emerging markets here, but I think you can give us some more insight into these markets. Thank you.
Well, thank you very much, Rob, and thank you for having me. So first question is, sorry, can you all hear me okay? All right, might be a bit of acrobatics here. So first question, what is climate tech, right? Some of you might have heard the phrase green tech or clean tech. Typically that refers to kind of low carbon or low GHG emitting technologies. Usually when we say those phrases, what we really mean is energy, right? So renewable energy, clean energy. But when we say climate tech, it's this ever-growing kind of taxonomy, right, about how are we reinventing our economy writ large, right? So if you take a look around the room, right, or even if you isolate your line of vision, just look what you're wearing right now, there's a good chance that what we're wearing, what we're using on a daily basis, what we're consuming, what we're producing, et cetera, was created via some type of like chemical scientific processes, right, where things were getting broken, burnt, reshaped, torn apart, thrown away, potentially recycled, though usually not, right? And that emits greenhouse gases, right? So at this point, I've taken us light years away from the energy sector. We're moving into the built environment, we're moving into transportation, we're moving into agriculture systems, right? That, yes, of course, energy is a cross-cutting theme, but we are looking at massive emitters that really are not that linked to the energy sector any longer, right? So think about steel and concrete. Sure, you need energy to produce them, but they are some of the most like toxic and polluting substances on the planet, right? So when we say climate tech, we have to think far beyond energy, right? We need to be thinking about how we reshape the way that we do business and build our economies and run our societies writ large, right? And to Torsten's point, somebody's got to foot the bill for that, right? Because to date, relying on altruism and hoping that we quote unquote do the right thing because it's good for business and you can do well by doing good, like frankly, that pitch, as you said, the private sector needs a pitch. That pitch has failed, right? And so we have to be able to develop an investment thesis that works here, right? Just slapping the word climate on it is not going to cut it, unfortunately. And what this means then is that we need to be thinking about both how do we reduce and remove greenhouse gases, but at the same time, we often, I think, fall short of realizing what happens if we were to even meet anywhere close to those trillions. That doesn't mean that the Earth starts to cool instantly, right? You were looking at many, many decades of a warming planet, irrespective of how close. Even if we were to get to 10 trillion annually, we would still be faced with a warming planet, which means that when you think about technology applications and the investment thesis around climate, it can't just be around greenhouse gas emissions. It has to be in this very important domain that has been significantly underfunded to date called climate adaptation, right? And I often, because I teach at university and I invest in this space, and I'll say to my students, it doesn't really matter if you have a vegan diet or if you have an EV, if you don't have water to drink, right? And so if we're running out of water, right, I just got back from a project in Morocco, which is the 27th most water scarce country in the world. I don't really think we're going to be too concerned about all the other kind of luxury items that we often talk about if we don't have anything water to drink, right? And the same thing, we move into biodiversity and nature protection, right? Because I was in an argument the other day with somebody where we were saying, well, what would you rather have, water to drink or air to breathe, right? And so we have to assume this very wide sweeping vision of what technology looks like and the way it's being applied to address not just GHGs, but the myriad risks that come from it, right? Because there's there's going to be more food and waterborne diseases, so you move into healthcare, right? It's going to be harder to insure homes and communities, so you move into the insurance space, right? Weather forecasting is not as widely available as we think, right? So if you're a farmer operating in Kenya, you may or may not have access to weather forecasting, right? So we need to be rethinking across the board kind of how we are building solutions, innovating, and how we're just getting them into the market, but how we're scaling them and they're staying in the market. Because when we say 10 trillion, what we don't mean is we need to take 10 trillion worth of shots on goal and hope that some of that works. Really what we're saying is we need to put $10 trillion to work and it all works and stands the test of time, right? And that, again, that gets lost in conversation. And what this means for emerging markets, and namely the Middle East, I mean, I think we're all probably on the same page. The Middle East is arguably one of the most climate vulnerable regions in the world, no matter how you look at it, right? If you look at it in terms of pure climate risk, you're looking at, I think, 7 of the 10 or 7 of the 20 most water scarce countries in the world, right? And at the same time, you have a number of economies that have built themselves around fossil fuels, and no matter which way you look at it, there is some type of transition happening, right? And how much can these economies withstand a shift in demand for oil? And so there's vulnerabilities across the board. I think we need to be careful in packaging the role of climate tech. Like, yes, I say climate tech and innovation has applications across economies. It's not a silver bullet, though, right? At the end of the day, we are the ones that are building and using these technologies, so we have to exercise agency in this situation. But I'll close with this thought here. So you all are probably familiar with the International Energy Agency. It's one of the most kind of authoritative bodies when it comes to putting out data and guidelines and frameworks to help us understand the green transition. What they've said is to meet our 2030 decarbonization goals and our 2050 decarbonization goals, and I'm sure some of you have seen these numbers, we have to rely basically 10% of the solutions come from changes to human behavior, 90% come from technological innovations. Within that 90%, to reach the 2030 goals, about half come from technologies that are under development. The other half comes from those that are in the market. To reach 2050, the breakdown between behavior and technologies is roughly the same, but we have an even more emphasis on technologies that have yet to make it into the market yet. So again, to keep going back to what Torsten was saying, is that we have to put money to things that actually work now, right? And if the vast majority of that is still under development, we have an enormous amount of innovating to do still, right? And so all the more important to be supporting entrepreneurs and doing so in emerging markets, right? The Middle East, by and large, granted there are large pockets of wealth in certain countries, I put it squarely in the emerging market category still. And we need to be thinking critically about this because, as we were saying earlier, the money isn't coming fast enough or in the volume enough And so somebody else has to get on top of that. And I do think local entrepreneurs and local innovation. I've been working in the Middle East for about 15 years and have watched the startup and technology community change dramatically. Unfortunately, got to play a role in working on that. There's no reason why they can't do it again when it comes to climate, but they have to realize, too, that they're starting very far behind the curve. Hopefully things like COP27 and 28, that they were being held in the region, helps to kind of ignite that change. But there's still a very, very long road ahead of us. And I'm very excited, obviously, to be playing a part in that, but I always have to add in a dose of realism to whenever I talk about these things, too. But thank you, and I'll pause there and turn it back to you.
Thanks. I'm going to reverse order here. I mean, you mentioned the money's not coming fast enough, and it's not at the levels that you'd like to see. I guess my initial reaction to that and the question I'd like you to answer: why and what can be done about it? So, what are the both on the entrepreneur side of the equation and also the investor side of the equation? What are the key barriers that you're seeing in the climate tech space? And what are potential solutions? And then we'll move to the other panelists. I'm curious, Torsten, too, to see from an IMF perspective, what are some of the challenges he's seeing in emerging economies, and in particular in the Gulf region, and how maybe there are some interesting overlaps and contrast to the barriers you're seeing. So if you don't mind taking the microphone again, I'm going to pass it back.
It's fine, yeah. So you might have to remind me of the questions as I go, but first one was maybe why isn't the money moving fast enough?
Yeah, and the main barrier.
Yeah, so think of it this way. So we still live in a society where if you were to come to me and say, give me $1, I would say, well, I'm going to need at least $5 back from you in a couple of years, right? Like, I want a return on my investment. And if Rachel said that she can get me 6, I'm going to say, sorry, I'm going to go with Rachel instead, right? So if the value proposition isn't there and it's not de-risked, right? Like, we still don't invest in emerging markets, right? There's a massive drop-off. It wasn't for the fact that the IMF and World Bank exist, emerging markets probably wouldn't see anywhere near as amount of capital as they do, right? So we, just because, again, as I said, just because we say climate doesn't mean the money's moving any faster, right? And also, we're faced with this weird story because on one hand, we'll say emerging markets are the most vulnerable, AKA they were perceived as risky before, and they're even riskier now. Why would any investor then say, I can't wait to start investing in emerging markets? Like, I've spent my whole career in emerging markets, but it's the same story time and again. And so we're having to revisit, I think, a lot of these old kind of barriers that we've never really solved, right? And so, and when I say barriers, you know, people will say everything from, oh, certain classes of shares aren't recognized in certain countries, but you also have a lot of information risk, transparency risk, the different accounting practices. You have, you know, the time it takes for an investor to quote unquote do a deal is about the same for a $1 million deal as a $100 million deal. And so if there's not $100 million worth of deals to be done, they're going to say, well, I'm not getting out of bed for that, right? And it's not a belief that I necessarily abide by, but I think I'm seeing some nods over here, right? Can you remind me of the other question? Sorry.
I think you covered it.
All right. All right. Well, hopefully I haven't depressed you too much, but I think that there's some. But I think it's in a healthy dose of realism. So.
Yeah. Thank you. You didn't depress us. I do want to bring in Torsten here, though, to give us an idea of to what degree these barriers and what Jamil has been saying about some of the challenges resonates with what you're seeing at the IMF and some of the main challenges that you're focused on for emerging economies, especially those in the Middle East.
Thank you, and yeah, Jamil, what you said, I totally subscribe to that. You know, obviously from an IMF point of view, some of the old barriers do still exist. So we continue to work on them, but they are difficult to solve. But also, you know, we are, with our new resilience and sustainability facility, we are also increasingly working with the private sector, because the idea with that facility is really also to scale up, you know, whatever money we give to the government. The IMF always gives money to the government, but then the idea would also be, you know, for the government then basically to present projects that they want to have done and to get the private sector and maybe the MDBs to sign up on some of these issues. But, you know, to a certain degree, I also have to say that there is sometimes some schizophrenia on the investor side. You know, on the one hand, they want de-risking, but then at the same time, they still want the emerging market returns. So I don't know how that fits together, but, but you know, there is an element of that, unfortunately. From from our side, the issue of capital market development is still a big one. Domestic resource mobilization, the pension funds in emerging markets could do more, but there are really regulations strictly preventing that, for reasons that are not always clear. So there could be, more movement on that side. But as I alluded to earlier, one of the things that could, I think, be very beneficial is to create country platforms, where governments outline what type of investment projects they want to have done, demonstrate some political backing, and then invite a wide range of investors to make their pitches. And unfortunately, it's not what's being done. It sometimes is as simple as that. I think Rachel also pointed to some issues. If we see a lot of industrial policies in advanced economies, it will not make life easier for emerging markets, because major investors might prefer, to cash in on whatever subsidies there are to be cashed in on. On the issue of de-risking, I think that's a very important one. I think in many things that we have put out, in writing or speeches, I think we do think that de-risking has a big role to play. I mean, at the end of the day, if you believe that a major issue in particular on the energy side is the capital intensity of some of these projects, when we talk about renewable energy, is kind of obvious, then cost of capital become really, really important. And so one big factor in the cost of capital is still the risk premium, right? That is actually the biggest factor. So if you didn't have a risk premium, for instance, is at least what the IEA estimates, the International Energy Agency, is that if you didn't have a risk premium, actually, for instance, installing solar capacity would already be way cheaper than other forms of energy. But then with the risk premium, is almost twice as expensive. So then the whole sort of, investment proposition changes quite a lot. And if you can somehow reverse that, I think it would make a difference. And here I think, MDBs are really also supposed to play maybe a bigger role. At the same time, what we recognize is also that for some countries, and here I come back to my argument about coal. So the single biggest source of emissions globally is energy production from coal. Okay, so if you could solve that somehow, even if you would move to, let's say, to gas, that would already solve quite a lot of issues. So nevertheless, we have probably a dozen countries where we have plans to expand the share of coal energy production in the energy mix, which is really a bad signal. So sometimes also here, if countries had these country platforms, other investors could come in and make propositions for other types of projects, right? I mean, that is something that is often not happening. And then also on the MDB side, coming back to that, I think if we talk about scaling up finance, then we also need to talk about, some sort of standardization of projects, if we think in the energy space. So, and it's not something that people think about. Oftentimes we do reinvent the wheel each and every time, we go to these countries. And that's just not a good idea if the argument is really about scale. The innovation argument is, again, totally different. But I think, the sort of IMF point of view is very much aligned with your view, Jamil. So investment in innovation is really key, and we need to see more of that. Mm-hmm.
Thank you. Before we open it up to the participants, maybe just Rachel give you the last word here to bring us back to the Gulf and back to the GCC. And can you maybe lay out some of the initiatives you're following? We're actually in GCC states. We are seeing strategies being put out, propositions put forth to different investors, and being met with a certain degree, optimism and also skepticism. So what are you watching in that space? And then we'll open it up to the group.
Yeah, I mean, part of what I'm watching, I think ties into very much what Jamil and Torsten just highlighted, this question of the financing. And one thing we haven't talked about, I know Bob McNally brought it up, but the interest rate environment, right? Which we haven't talked about it because it probably goes without saying. But to that point of this expectation of where hurdle rates are and other things like that, and particularly, I think this sort of structural shift in, if you think back when I started out as emerging market analyst, too many years ago, that element of high risk, sort of high risk, high return. There are still countries where that's the case. And then the other big sort of elephant in the room linked to interest rates is the debt dynamics, which of course, not all across the board, but were exacerbated by the pandemic and other dynamics. So that the fact that outside of this sort of discussion and question mark about where's the climate finance, there's still issues of, we don't have a working common framework. We don't have kind of easy, we can, that's a different discussion we can have in another sort of context, but it takes a long time and countries worry about the sort of rating implications. So I think that sort of element and question mark about how to get more sort of equity capital, how to do different things. So, but anyway, the more positive side maybe to is this dynamic of we have particularly out of national energy companies and all the national oil companies, trying to rebrand themselves in that context. And, we have some of these sort of projects that do seem somewhat similar, sort of rolled out across different North African countries, from the UAE in particular, also some sort of in sub-Saharan African countries and other dynamics. On the sovereign fund environment, I actually think there you've seen less investment, with the exception of course, the Public Investment Fund that is really involved domestically, right, and involved in this whole sort of reallocation of the Saudi balance sheet. And I won't say more about that because Tim Callan is the one who, sort of really unpacks that. But I do think that sort of dynamic, and also Gulf, sort of funds in different sort of places, really, yes, investing in innovation and testing cases. One thing that I didn't allude to, but both in things like the Chips and Science Act and in the IRA, things like the challenge grants and some of the other things, which arguably, when those of us who spend time thinking about what elements of these industrial policies might go as Congress shifts and as there's a potential, sort of administration change, some of those sort of innovation grants and things like that are probably one of those that we figure might get axed. But we have to build the new system while still living in it, and know that we don't know all those, all that question. So we don't want to just end up in a path-dependent, world in that regard. I've gone beyond the Gulf again, so I think I will stop there, except to say that, and good, we've prompted people to start putting their placards up. But, I guess I would only sort of leave it in the context that where our conversation, there's a lot of ambition, there's a lot of interest, but we are looking at an environment of, with that question mark we were having at the end of not the end of the morning, the middle of the morning, about how particularly large producers like Saudi Arabia are going to adjust to this new normal, and having so many different domestic needs. I think it results in an environment where both there'll probably be less foreign investment, but it might also mean that their choices in some of the foreign projects will be more tied into other areas of national interest. But that's probably a whole other conversation we can have. Well,
Members of the audience can prod us to continue that part of the conversation if they'd like. So we'll open it up right now. Tim, do you want to kick things off?
Took Tim's name in vain, and now he has a question.
A broad question for everybody on the panel, not focused. So the scale of the numbers is huge, right? So we're talking 6 trillion plus. I think global GDP last year was like maybe a little bit over 100 trillion. So this, 6% and upwards. Now, I think, Torsten, you said that's not additional, but would be reallocated. But if it's additional, it's huge. If it's reallocated, it means a lot less investment in something else. So where is, I guess, where is it, you're going to invest less going forward to accommodate this? And then secondly, maybe, I mean, this is more of a comment, but if you pull some of the things together, you've got, increasing fragmentation in the economy, which is not what you want for technology transfer to get out to help this. You've seen foreign direct investment on a downward trend for 10 years, and you've seen many countries with growing fiscal issues. So, you put all of these together, it's not a very, encouraging environment for getting this financing going. So, I guess a question, and then if anybody has any comments on the latter part. Thank you.
Yeah, I think, Tim, you're absolutely right. So maybe the absolute numbers sound daunting, but they may actually be not as daunting as they sound. So overall, our estimate at least is that we have, so the share of global total investment that is going into climate right now is probably 3.5%. I think our estimate was 3.4%. And it needs to go to around 12% of total global investment. So it's not impossible. At the same time, a big change, right? So you talk about 3.5 times more as a share than you had before. But, so talking about the energy sector, it's really going to be a reallocation, towards more clean energy. So I think the target number there. So right now, depending on how you measure it, the ratio between investments in clean energy and fossil fuel investment is probably around 1.0 something. Okay, so we are, for the first time, we're kind of even in terms of where we put the money. But actually, if you believe the numbers, it has to go up to 4. So the ratio needs to go up to 4, and that's massive, right? So it's not going to be easy. I mean, that's the scale of the problem that we're talking about. And so it's going to be big, but at the same time, I think maybe we're coming also across as too negative because there will be so many great investment opportunities at the same time, right? I mean, one of the positive aspects in all this that we have seen is that investors are very interested in the climate space. They really are. Now it's about, finding the projects and providing the investment environment so that you can actually make money out of it. So, from some of the countries that I've been working on, sometimes, the problems are quite obvious that need to be solved. So in the energy sector, for instance, you have in many countries still monopolist producers who do not allow private energy producers to feed energy into the grid. Stuff like that. If you would change that, if you would open up the market and let renewable energy producers in, that would obviously, huge changes, right? And also definitely an increase in investment without the government having to step in necessarily, right? It might solve itself. So a huge opportunity still, that are, I think, untapped so far, while still it's going to be challenging.
Thank you. Thanks a lot for the question. I mean, I think short answer, just to build off of what Torsten was saying, is so on one hand, I think that we're getting a lot better at defining the investment proposition around energy, right? I think that's the strongest of all the different investment domains around climate. A couple of years ago, we were thinking that decarbonized cement and steel was a moonshot that was probably in an MIT lab somewhere, but it's not uncommon now to see venture capital funds in particular doesn't mean that they're going to get their money back, right? but it means that they are waking up to it. So I think our hope is that investment thesis that was forming around energy will quickly make its way into other domains. But I think we have to keep in mind that, and I think you were getting at this earlier, Torsten, is that a lot of this is hardware, right? And it grows and returns capital at a very different pace than software. And we've made so much money as a global population off of software in the past couple of decades that we've kind of gotten a little spoiled, I think. And so we need to keep in mind that this stuff, right, like the stuff that you have to touch and feel and test over years sometimes before it even gets in the hand of a consumer, takes quite a while. And that's where a lot of de-risking comes from. The second point is people always ask, well, what's the source, right, of all this, right? Because if you could remove subsidies, you can reallocate capital. And I think after a certain point, people are like, okay, but we need a lot more than that, right? I mean, the impact investment space has been around for a few decades now, and they always talk about insurance companies, pension funds, endowments, and family offices and foundations as like 4 to 5 resources that are very untapped. But I do think you still run into this issue of what's the investment proposition to them, because those institutions were not built to quote unquote save the planet, right? They're built in order for capital preservation purposes, right? I mean, I don't want people gambling with my pension money, right? And so there needs to be a perfectly clear and de-risked investment thesis that you can pitch to them, because otherwise there's only a small fraction, I think, that are going to base their investment strategies off of altruism. After a certain point, the math has to add up and has to be more attractive than investing in the S&P 500. And so I think until we can get to that point across the board, it's going to be really difficult to move any of this capital. Rachel? Yeah.
Just really briefly, I know people have been waiting, and we're cutting into the time of this session. Related to that, I think there's an element of like picking, without picking winners, but picking some of the areas, particularly on, in the sort of, energy sort of, commodity space, and the areas sort of thinking about smarter ways of whether it's incentivizing strategic reserves or thinking about market-based mechanisms for sort of some of the less liquid, less sort of traded commodities that are going to be important in the space. Again, this is one of the cases where we don't necessarily know where all the infrastructure is going, but in thinking about and trying to be creative about the different ways that we're sort of de-risking, so it creates an environment where people are, crowded in. I'm sure a conversation that will be continuing.
Okay, we started a couple minutes late, so I'm just going to go because we didn't get to go to too many people around the table. In order to do this, we'll have to keep the questions to very brief questions, and we'll just pick maybe for each of the speakers here, just pick one question or so to very briefly comment, and then we'll just have to wrap this up to get to the next conversation. So I think Thomas, I can't quite make out the other participant over there, and then Jonathan, and oh, sorry. Yeah, and I think that will bring us to the end. Thank you. Oh, okay.
All right. So in the literature about resource curse, price volatility is one of the key reasons why these petrostates find it very hard to reform their economies, to diversify from oil dependence. But I haven't heard much of an analysis on, and hence my question: how does price volatility factor into this energy transition, especially for the petrostates themselves? Thank you.
Thank you, Jonathan Chanis. I still don't understand how this is supposed to work. Bill Gates, over a decade ago, said that anyone who thinks that the energy transition is going to make energy less expensive doesn't understand how things work. So if you're talking about taking energy investment from 3 to 12%, that's an incredibly large change. So, there's a couple of ways you can do that. One is you can starve other parts of the economy of 9% of investment, or you can increase total investment, which means that we have to consume less, which is also a non-starter. A third way is to create inflation, which is kind of what we did with the IRA. And that's also a suboptimal way to do it, but that's what really de-risking means. De-risking means you socialize the losses and you privatize the gains. So all of these outcomes tell me that going from 3 to 9%, it's just very difficult to make happen, no matter what we want and what we think about climate change.
All right, thank you. Rachel, do you want to take the first?
Sorry, I should turn the thing on. Yeah, price volatility, very important. What I said right before you answer your question was sort of one very small piece of that, which is trying to solve a different problem, which is the dynamics that we have seen boom. Yeah, I mean, we see, look, we're all in the commodity space. We see boom and bust cycles all the time, but we've seen a particular one recently in lithium and other battery metals and the like, and this is partly a function of heavy sort of Chinese investment. And so trying to think about, without sort of trying to create a completely managed economy, what are some of the tools that could incentivize it? Dealing with the time inconsistency and the fundamental gaps, right? What are some of those tools? Now, your question is about a different or potentially a different element, which is how do these countries, how do these countries that are, have been producing the sort of core energy commodities, how do they plan for this? Some of it is with the sort of adjustments that we've been talking about, these sort of ambitious investment plans in other sectors. I think there's a lot of people around the table that are somewhat skeptical of diversification, plans, but this, sort of transition, of the economy. I think we've seen a real, if the solution that we would give to the resource curse some decades ago was save the money when prices are high, keep it offshore, have it available for the fall, and that's where a lot of the sovereign funds in the Gulf, that was the philosophy they were created from. I think we've really had that change. Not only was it political, right, the demands at home, but also the recognition that I don't think any of us have fully grappled with, which is this element of, well, energy demand might keep coming up, but it's different energy, sort of energy commodities and other, and other channels. I think, I don't know that I can do better justice to the question in the 30 seconds that remain, so I think I'll stop there. Oh, sorry.
Maybe just for a last comment, Torsten, you're a bit more optimistic than I think Jonathan was, so maybe I'll give you the mic for the final comment, and then we'll have to wrap up.
I think I am a bit more optimistic. So there are two reasons, I think, for being a bit more optimistic. I think one is that, when I started to work on these topics in 2015 or so, I think back then there were a lot of very smart people who did all the estimations as to what the cost of renewable energy production will be and so forth. And these cost curves have changed a lot. I mean, it's so much less expensive than we had estimated only 10 years ago. And I have a lot of confidence that I think costs will come down further. At the same time, and also coming back to something that Rachel mentioned, in this space, capital costs are really key. And the issue with higher interest rates is simply that it has changed, I think, the relative value proposition of some of these renewable energy investments. I totally believe that, at some point, just by substitution effects, we will reach the 12% in climate-related investments. But it can only happen, if the costs of producing that energy are lower than other costs, and high interest rates will not help with that. But I think technological process, if we have people like Jamil working on that, I think we'll do the trick at the end of the day. Let's see.
All right, thank you. I think we'll bring this to a close and get on to the last panel. Thank you very much.